Elena Esposito has driven systems theory forward. Her book on the social function of fashion has also made her well known outside specialist circles. For some time now, her research interest has focused on the processes taking place in financial markets, financial models, mathematical models applied in financial markets. Time and space are annulled there. The computer has taken control. Welcome to the conference. Thanks for being here, Elena Esposito.
Thank you. Oh, thank you very much. Does it work? Yeah, wonderful. Thank you very much for the invitation, for the so kind introduction. And actually, I have to say, I think I'm quite lucky to have the opportunity to talk quite late in our conference. Well, except that everybody's tired now, including me. But I think it's nice to talk after having heard so many interesting presentations under many points of view, but among others also because if I were to sum up what we heard in the different presentations, I had the impression that almost everybody said we don't really know what's going on now in financial markets. And that's for sociologists, there's also an interesting point of departure somehow. And that's more or less what I would like to start from. Well, we are thinking now, reflecting this conference about money and debt, and exactly about these points, I think that's really we don't know what's going on theoretically. And that's one of the consequences of the financial crisis, as we have been discussing many, many times during these days. Because now, well, the financial crisis, the official burst of the financial crisis is already a couple of years old. And in economic terms, well, people seem to think that financial crisis has been stabilized. And we always hear of people saying that the crisis maybe is over. Could be, could not be, we can doubt it. I think that most of us doubt it. But anyway, what seems to be more certain and undisputed, that we cannot really say that the crisis has been really processed on the theoretical level. We have no more than no theory that can really explain how the crisis arose and what was really going on and what's still going on financial markets. There are, of course, some elements that are discussed, analyzed, among other the over-evaluation of the growth of the real estate market, especially in the USA. That's really the point of the crisis. And basically, the intransparency of structured finance, the lack of regulation, the excessive power of CEOs and the rating agencies, and some other elements, which, of course, are important, are part of our landscape we have to reflect on. But still, I think we lack a convincing overall picture. What did we really wrong that led to the crisis? And what we are still doing wrong on financial markets, and why? How could a situation arise in that time, and still now, in which apparently finance, with all its models, with all the strategies, with all these complex, refined devices working on that, apparently went its own way, without any link with the development of the so-called real economy, Main Street, as people say, and without apparently anyone who could stop what was going on or really wanted to stop it. So the circulating theory doesn't really seem to give an answer. And my idea that maybe we could try to change orientation and to go back to a different interpretation of finance and of the economy in general, one that has a long and prestigious tradition, but was always, in a way, a bit overshadowed in economic theory. The idea, that's an old idea, but which could go back to that in order to understand financial trends, and today particularly the new, still quite mysterious movement and the use of financial instruments, we could, or we should, rethink the role of time in economics. That is, if you want, the time of money, which is still quite mysterious on a theoretical level. We could ask then, how does economy deal with time? How time changes depending on how it is used? And finally, what time altogether is, if time depends on how we use and how we understand it. Because time has actually always been one of the crucial and most criticized issues in economics. The proposal to go back to time and to think about time in economics is, as everybody knows, not a new idea. It's certainly not new to complain that economics, which is based on models of equilibrium and of coordination, not very plausible but still being used, is a static construction. A construction which does not seriously deal with time. time in the sense of not just succession, not just sequence, but time in the sense of historical change, of innovation, and of surprise. This is a classical complaint of the Austrian school. We have been talking about von Mises, Hayek, these kind of authors. But also Keynes dealt with time. Keynes' approach actually starts from the crucial observation that economic decisions are always uncertain. Well, one thing would think of Knight, but we refer now to Keynes. Economic decisions are uncertain because they are made, I quote more or less from Keynes, they are made referring to an unchangeable past, but address what he called a perfidious future, an unknown, dangerous, worrying future. So Keynes clearly recognized the role of time, not as simple sequence, but as uncertainty and as indeterminacy. And what I think from our point of view can be very interesting with Keynes, which I don't want to go into detail into, is the idea that the ignorance of the future, which is the mystery of time, is essential. It is as the basis of the particular temporal relationships of economics. It's not only a problem, nuisance, it's something we should be able to deal with and to use. Because, that's Keynes' idea, all in a world in which the future is not only unknown, but basically unknowable, how is our relationship with the future, then only this time we can be really creative and innovative. We can really have innovation surprise. This Keynes' idea had a lot of followers, among other particularly Shackle, who said really that the world of economy, his word, feeds on uncertainty. Shackle always also accused the mainstream approach to economics to disregard the role of time, considering it only as a nuisance and a disturbing complication, something that makes the life of economics more difficult, and not understanding that time actually is a resource in economics and a resource in the economy and a resource for economic thought. The economic practice actually always actively exploits time and orients to what it calls time to come, that uses and enhances creativity, imagination, and innovation, just because the future is unknown, which is not a problem, it's a resource. Because that's the basic idea, money in its essence is time. Not only time is money, but more basically and more importantly, money is actually time. We need money not to satisfy our present needs, not in relationship to the present, because of a trivial observation that if we really satisfy our needs, we don't have any money anymore. So it doesn't relate it to the present. Money is needed in order to be reassured toward the future, to be reassured in the present with regard to our indistinct, unknown, unknowable future, and particularly in regard to future needs. Because, of course, we don't know what will happen in the future, and we don't know what we will need tomorrow, what will be our needs in the future, but we know that we have needs. And we know, and we would like already today to know that we will be equipped to meet our needs when they will arise, even if we don't know what they are. And the only thing we know is that if you have money, we will be able to satisfy these needs when they will arise, even if you don't know what they will be. So if we will have money, we will be able to pay. And if we can pay, we can satisfy what we need. Therefore, the idea, we need to have money. And therefore, also, money is never enough. The strange idea that present needs can also be finite. We can maybe theoretically satisfy all of them. But we can never satisfy all future needs. That's why money is never enough. We need even more money, because the future is unknown. Money and this social use has, well, I'm a sociologist, social use of money, first of all, this meaning. The meaning of a kind of non-specific reassurance against the indeterminacy of the future. Relying, in this case, as a resource again, on the indeterminacy of money. Because money, as we know, doesn't have its own use. Money has no use value, as we know, but stands, in a sense, for an unspecified range of possible uses. We can use money for everything, basically. Not everything, but all what you can buy. And money stands for all these possible needs. Money, to sum up, stands for future possibilities. And that's why we need money today, referring to the future. That's about money in general, but our point are financial markets, and the idea was already in Keynes, but that's not what interests us. The interesting point here is financial markets actually deal with these future possibilities. Money has to do with the future, and financial markets deals with these possibilities that are open in the future if we have money. Financial markets intertwine and compensates future possibilities, imagine and deny them, and produce, basically that's how they work, produce present profits out of the very fact that the future is unknown. Basically, financial markets do in a more radical way what money always does, what money always has done, to handle and exchange in the present the uncertainty of the future. Financial markets do it in a more clear way. Financial markets do not sell goods or services, not even indirectly, not even deferred. That is something we should actually forget. It's not realistic anymore. They are not interested in how things are and how the world goes. That's not their job. They are dealing with something else. They also, that's well known, they do not depend directly for market trends because, you can earn money on financial markets when the primary markets go bad and lose money when the markets go well. So that's not a direct dependency on production, even if it's always been complete. But the question remains open. What do financial markets depend on? What do they really sell if they don't sell goods and services in no direct or indirect way? Well, today there are theories about that, and they tend to say that financial markets, especially the esoteric, strange, mysterious financial markets equipped with structural finance, and also especially with the giddy and mysterious circulation of derivatives, well, they first of all deal with the management of time. Time, especially in the form of risk. We have heard it in the presentation of Wolfgang Koy, the relevance of risk on financial markets. They deal with the sale of risk and of the game of influences and links between the present view of the future and the way in which the future really is realized. That's the point of risk. We don't know how it will come about, but we are already today trying to prepare ourselves for the future events. So what you buy and sell on financial markets is actually the possibility to create constraints on time, to combine these constraints and to get out of this combination of future possibility a profit opportunity in the present. Opportunity which often rely, we could say, on the present use of the future, even especially if the future remains unknown. We know that credit has always been present use of the future. That's why financial markets, we deal with credit, actually sort of accelerate and intensify this way of using the future in the present. That's particularly clear in the case of the now infamous and bad-known derivatives. Futures, options, swaps, and similar instruments, which have become, not by chance actually, the fulcrum, the central point of the dynamics of financial markets, and also the most mysterious phenomenon, if you want. I think that it happens particularly because they have a number of features that allow you to withdraw from the concrete data of the world and from the actual present, and to refer directly, much more freely than in other cases, to time and to the management of time. If we think about it, all derivatives are, even if they are different from one another, of course, but they are all of them contracts that refer to the future, with more or less extensive degrees of freedom. Future, for example, the most basic, simple case of derivatives contracts, as everybody knows, there are agreements between two parties to buy or sell something at a future date at a specified price, a price that has been specified already today, a price which is set in the present and is usually different from the current market price of the good or the activity, it's a so-called spot price, but also from its future price. That's an interesting point. And the options do, interesting enough, more than that, because they have similar structure. But with option, the bearer, the one who buys an option, acquires the right, but not the duty, to do what the contract deals with. So he can still decide in the future whether he wants or doesn't want to buy or sell this activity, this title, or what it is. So if he prefers to exercise the option or not. So we could say that the one who buys an option buys basically the possibility to take a decision in the future, but doesn't have to do it, doesn't have the duty, doesn't establish yet now how we have to decide. In a sense, he influences, he binds the future, but doesn't bind himself. He does not constrain his own behavior. He can still decide in a different way when the future becomes present. That's a quite refined and interesting way to deal with the future. And that's what I think one can observe that most tools on financial markets basically do. We can say that these tools produce the future with the very operations that try to anticipate it, that try to prevent from risk, but actually they have an influence on the future. They produce the future. Selling derivatives, for example, you assess your influence in the present, assess already in the present the conditions of the future, and then look at how things go, how things happens. Then you look at what really becomes actual when the future comes through. So the one who buys an option generates the constraints that affect the course of time, and thereby contributes to create what will happen in the future, contributes to create the future. But then, when the expected future becomes present, he can still decide otherwise. So in a sense, we could say that with derivatives, the future is bound and open at the same time. And markets, financial markets, actually deal with these bindings and the transformation of these bindings. They deal, as we could say using other words, they deal with risk and with the management of risk, because risk is actually binding the future. This happens, as we know, in very complex and very sophisticated, refined forms. My point here is simply that if you don't consider the role of time in this movement of finance, these movements appear to be purely virtual, inconsistent, and often, as they are presented, driven by an incomprehensible irrationality. And this is how financial markets are usually presented. They are presented as a realm of hazard, of unreason, despite the use of computers and despite of the use of complex, very formalized techniques. If you don't take into account the role of time, you will unavoidably be continuously surprised by the so-called surprising movement of the markets, what Wolfgang Coy called the unknown unknowns, which are, of course, continually produced because the future is open. The future is made of surprises. And if you don't consider how financial markets produce the future, we will be continuously surprised by these surprises. But we should be able to do more, to do better, something better. We should be able at least to expect surprises, because we partly produce with surprises with our very behavior. I try to make it a little more concrete. Also because this kind of description goes against the official and standard description of financial markets, because apparently financial markets should be very well equipped to deal with risk. That's the ideology or the narration of financial markets. And indeed, we have heard it by many presentations these days, in particular since the 1970s, very formalized financial techniques have spread, also supported, especially supported by the use of computers, Fabian mentioned them before, which refer actually directly to this issue, the issue of risk and of the management of risk. We have a very complex model to calculate risk, starting from Harry Markovy's CAPM, that's well known, value at risk, these kind of models. We have procedures for estimating the price of options, to estimate volatility, so Black-Scholes formula, well, the one going back to Bachelier models Kevin was talking now about a little before. We have a lot of techniques that apparently should allow to predict and to manage the distribution of risk in markets. Well, techniques that promise at least to do so. That's why, according to many observers, financial markets has radically changed in recent decades, since the 1970s. The always open question, is everything different, everything the same? And of course, this question can never be answered in a definite way. But something is different since the 1970s, because, well, derivative markets exist since much, much longer time, exists at least since the second half of the 19th century, and tools such as options and futures, derivatives actually, have been tracing back as far as Mesopotamia and ancient Greece, so they are really not new developments. But today, the available techniques, with computer-supported techniques, this structural finance, dramatically change the role and the significance of risk. And that's what something that really can be observed as something new. Therefore, finance gets a previously unknown and somehow unthinkable importance and an unprecedented extension in our society. Like also Maurizio Lazzarato said, it's financial capital is yes, getting much stronger than other forms of capital. Why? We could say that one of the reasons is because financial techniques, as we have them since some decades, transformed risk in a kind of object. An object you can sell, buy, and resell. And that's what happens in the financial market. You can compensate different risks with one another. Or, if you want, you can multiply them, creating new risk and watching what happens. Today's financial markets sell and buy risks. That is, they sell and buy future uncertainty and shouldn't be explained referring to this performance, which is not a component or an additional complication of financial markets, but it's actually the real object of the transaction. Risk is really what is really being sold, bought, observed, and anticipated in financial markets. That's the point of them. That's also why, in recent decades, the role of risk in market has changed. Even if you often don't really realize what's going on. Because risk was always an issue, but we could say that before having these techniques, since older times, you sought protection against risk on financial markets. Now, you sell and buy directly risk, not a protection of them. Risks are really objects you are selling. Financial markets are directly risk markets, and they often do not really care about where risk comes from and how things are. What they are about is the perception of risk and the evaluation of risk on the markets. And in many cases, well, the calculation refer to this evaluation compensation dealing with risk, management of risk. But we know that in many cases, especially after the crisis, we know that all this calculation didn't really work. Indeed, we know that even that using calculation for risk control actually multiplies risk. It doesn't protect us for risk as promised, they actually multiply risk. But why? What was wrong with this calculation? Because apparently the idea was very rational and so sort of plausible. The problem, I repeat myself, with the risk management models, they have a too simple, even very complicated idea of risk and the idea of time. And this is what becomes risky, not risk itself, but a too simple way of dealing with the risk. Why? Because these risk management techniques, they collect data and make projections about the future, but about the future as we see it today, as about our present view of the future. And that's how they calculate the beta, they calculate volatility, and so on. But they also refer to the present view of the future. Even if they are not naive, they know that the future cannot be predicted. They're not just an idea, we know how it will happen in the future. Everybody would complain if you accuse them of that. They are much more clever. They know very well that we cannot know the future in advance. Or, to put it another way, they know that we cannot know today which of the possible future comes true. And that's why the model do not consider only one future course, but they take into account that they say several different futures, or even, since they have this huge calculation capability, the idea or the promise is that this model take into account all the possible courses of the market, all the possible futures that can become actual in the present. So the idea is that a more capable handler or trader or a more powerful system can consider several alternative futures, or ideally all possible alternative futures, and combine them with diversification, with hedging, with techniques that compensate with this future with one another. So the idea that this handler, this trader, this system will be prepared however things go. That's why actually you don't need to know the future, because you are prepared for all possible future developments. That's the idea, completely implausible if you think about it, but which had a sort of rationality behind this. The idea that people equipped with structural finance will work in the ill-famed, famous risk-neutral market. A very strange idea, but which has this calculation behind. The idea that it should be a market without risks for the careful handler. You don't need to know the future ahead, because however things will go, whichever of this future will come true, you will be protected and will always have a profit, in a sense, only fall on your feet, in a sense. And interesting enough, they are not saying that they are risk-free markets. They talk of risk neutralization. So risks are not cancelled, in the sense that nobody claims to be able to eliminate uncertainty, or again, nobody claims to know how the future will be. They are neutralized. It's a apparently more modest idea. The idea is that risk still exists, but the idea of the ideology of the narration is that the risk should no longer be harmful for the people using the systems. Then why shouldn't you risk? Where a reason should be to avoid the multiplication of risk if they're not risky anymore. So apparently, according to these models, you can risk more, risking less. Because even risking a lot, you will never have any damage. You are protected because this risk will be neutralized. And then, of course, you tend to multiply risk, as the crisis, as we know, abundantly showed. Or I'm referring to what Fabian was mentioned. This also changes the idea of schuld, of sin connected with risk, because if you're really risking, you are not risking anything. The one to blame is not the one who risks, who is generous, who is sort of brave, who's bringing the economy into movement and so on. The ones who should be blamed, as actually in Italy happened, are the people who are not brave enough to take risk, because if risks are not risky, why shouldn't you risk? You bring everything in movement and you will have a positive outcome for you and for anyone else. So more or less the idea. But we know, of course, now that it didn't work. Even it was not such a, I want to stress that it was not such a crazy construction. It has a sort of, well, we can say perverse, but it has a sort of rationality guiding that. We know now that actually a risk multiplied. So, but still the question is open. What did really not work? Why did this mechanism not work? What was mistaken in this construction? What is mistaken with the idea of models for managing risk into financial markets? My guess, as you can of course know now, that this mechanism didn't work because of the way it handles the future, because of a too simple idea of the future, because what gets real, in fact, in the future is not the anticipated future, the one you expected, and not even one of the possible anticipated futures, not one of the future you were considering your models. What really comes about is another future that you couldn't predict and you couldn't control. Because this future, the future that really becomes real in the future, is the one that depends on our present behavior and also on our attempts to control this future, and that's something you cannot predict. I'll try to quickly show it, referring to the crisis that we already know, which has been analyzed, and to try to reconstruct it very, very shortly from this point of view. The beginning of the crisis, the ill-famed and very famous subprime mortgages. When everybody, now it's easy to say they were crazy. It was crazy to grant credits to everyone. But again, the construction had a sort of rationality, because the calculation that led to grant credits to everyone was not groundless. It was not sheer recklessness. It was not sheer, well, unreasonable. Credits were freely granted because one thought that even risking a little, basically, you did not risk. This idea that we are presenting now. And the calculation seemed to confirm this. The idea was, we know, as Wolfgang Koy said, there are always people who don't pay. Not all credits come back somehow. But the idea was that it was not really a big problem, because even, and especially if you grant credit basically to everyone, as I experienced, I got a mortgage and I was not really a very affordable credit taker. So even I was not a ninja, but the idea was that even a certain number of ninja, so no income, no job, no assets, these people were so discussed at the time, even some of them don't pay their installments, that wouldn't be a big problem because the value of the house was expected to go up anyway, so you could make another mortgage as a credit, where they want to get credit and repay your debt. Moreover, the idea was that possible insolvency was absorbed into complex packages of securitized credits, ABS, CDOs, and so on. We know how it was. So the idea that this risk which you should be protected on anyway because the price of houses was expected to grow, but anyway something went wrong. With these packages, the risk was distributed on so many different agents that it would have become irrelevant for each of them. So actually, there should be no real dramatic risk. Well, now we can smile. Of course, it didn't work. We know that. But why didn't it work? Not only because the house of prices fell, because we know the consequences of the crisis were much bigger than a problem on the real estate markets. The consequence of the crisis went far beyond real estate and far beyond the actual insolvencies. The crisis was much bigger than the credits that were really not paid. The crisis grew out of proportion if you look at what the real damages. So apparently the public began to see what was going on and began to see how speculation worked and reacted to the very fact that speculation was being realized. So we could say that the whole process was based on the fact that, as we said, one sold today a constraint on the future. That one used today tomorrow's money. Actually, mortgages are more or less this. You use today the money that will be produced tomorrow. And even with all the flexibility of compensation, these alternative scenarios, all the possible futures that apparently were considered in the models, even consider different futures, you were not equipped to face that. Because what you consider, I repeat once more, were all the futures that you could imagine starting from the present. But the problem is that the future one buys today still isn't there. And when it gets real, that's when it becomes present, it's always different from all scenarios you could imagine, where all possible future you were prepared for. Because this future, the future that becomes real, is changed by our expectations, by our scenarios. It's a future that is influenced by our efforts to prevent and to protect us from this future. And that's what people began to observe. People began to observe the models. We could say that the calculation of securitization, for example, referred to a future without securitization. And referring to that future, they were, of course, rational. They were right. The models were not wrong. They were only too simple. Because that future, the future without securitization, of course, was not the future that really got real, because we had securitization. And that's a problem of model in general, because model can consider all possible futures, let's say, in a more complex way. The perfect model considers all possible futures, except the only one future that really becomes real, except the future influenced by the use of models. And this is just a future that comes true. So the sociology knows since long, actually, that the more we try to predict the future, the more we act on the future, the more we influence the future. That is, the more we change the future. And then the future, of course, deviates from our prediction. And that's a sort of recipe for producing surprises. Therefore, we could say all this model used to manage and to calculate financial risk did not work, because they only refer to the future as it could be imagined in the present. They did not consider, nor could they consider, how the future reacts to the attempt to control it, and to our interventions on the future, to our active production of the future. That's, of course, we can't predict. That's another way to say the future is open. That's something we like. The future is open, it's made of surprises. And that's something we cannot be protected against. So at the time of the crisis, in a sense, we ended up with many futures already bound by our operation, futures that were already being constrained. We had to pay installments. We had many constraints on the future, but with no possibility, open possibility available once the future really became present. So the idea was, the impression was that the future had already been used in the previous time. So when the crisis came, the scaring impression that we had no future, no open future anymore, because everything had been bound and constrained and used in the past. The impression was of being without a future. And that was really paralyzed markets. This, we could say, explained the credit crunch and deflation, or the fair deflation. We didn't really had a real deflation, but there was a real possibilities. Whereas formerly, before the crisis, in this irrational euphoria, as had been called, the future was too much used in the present, transforming, as we said, future availability into present wealth and using this wealth already in the present. Now, after the crisis, nobody really wants to use the future anymore. And that's what paralyzed the economy. Because economy and money are basically always use of the future in the present. If you cannot use the future in the present, you cannot make an economy, because that's what the economy is made of, even before financial markets, before the crisis. So, but now, what can we do? Can we do otherwise? Could we do otherwise? What can we learn for these not so nice developments? Risk remains risky. Wolfgang Coy said it. This riskiness, the riskiness of risk in a sense, cannot be controlled, cannot be anticipated. And that's a resource, I repeat, according to Shackle. We wouldn't want to control really the riskiness of the future. We wouldn't want to have a closed future somehow. But we must act differently. We must deal with a much more complex view of risk and of the future. We know it by now, even if in a quite vague way. And we can observe that without a theory dealing with that, financial markets already take it into account. They act in a more, well, aware way, a more careful way. Even there's no theory that explains it, and there's not even a technique that tells us what to do. But the trend of volatility seems to show this increasing awareness of the market, increasing worry of the market. For example, the volatility skew Benoit Mandelbrot, who has been mentioned by Kevin before, studied. The volatility skew reveals that financial markets apparently are beginning to expect surprises, what we were referring before. In a sense, financial markets expect that unexpected events, the famous black swans, happen. That seems to be widespread. The trends of volatility show that they can be like that. You expect surprises, in a sense, even if you don't know how to do with them. We expected that events will happen that our calculation, our tools are unable to control. Because, as we know, these black swans, this unexpected event, arise out of the very fact that we use calculation, we use models, and that's what we cannot calculate. I'm repeating that. But by that, I would never want to say that calculation techniques are negative. They shouldn't be used. Of course, we have to use them. Of course, that's the only way we can move in the market. Otherwise, it would be this monkey system, which is, of course, fascinating. But well, if I were a handler, a trader, I wouldn't be very happy to have a monkey doing that. So, calculation techniques are useful, but they could be used, and maybe they should be used in a different way. We should know they don't offer any certainty. They offer any guarantee about what we can expect for the future. That's not the reason why we need calculation, not the reason why we need models. They should, in a sense, if you can say it this way, they should be used not to avoid surprises, but to be, in a sense, better equipped to deal with them when they will inevitably arise. In the highly abstract, people say exotic markets of structural finance, apparently the most competent actor is not the one who's able to predict and to manage risk, which of course is impossible, but maybe the one who knows how to deal with the unpredictability of risk, knowing in a sense that risks depend also on what we do or we don't do in the present, also and just in order to manage risks. It sounds like a game of words, but actually we can observe how things happen. Tools to do that are already available. They are used actively in financial markets. Even, I repeat, what we still don't have is the ability to interpret them differently from how we are used to do. So we still have theories that are inadequate to what's going on the markets. In a very simple way, we could say that logic to deal with this preparation use of the future is what we can observe in, now well-known instruments like derivatives, like the options that we have been mentioning, because they have in a sense, options have an interesting, strange, circular way of dealing with the future. Maybe that's the reason why derivatives in general are so powerful. Take the simple example, much too simple example, but just to have an idea of options. We have already been talking about that. So with options, you decide something for the future. You decide you will buy a stock at a given price. You already decide and fix it today. You make a contract about it. Hence, you buy in the future. But you still keep the possibility open to decide otherwise if things don't go as you expected. So we know you don't exercise the option if the price is not convenient. You do not buy, you do not sell if it's not convenient when the future becomes present. What is the idea? The idea that markets react to the circulation of derivatives. We produce the future with this traffic with derivatives. We affect the future. Stock prices also depend on the movement of derivatives. So handlers use calculation models to produce the future, which otherwise will be completely random. In this way, they keep in touch with the world and with the real economy. They produce really the future, have an active role in producing what will become present in the future of financial markets. But then they look at what the future does, learn in a sense. They look at what the world does with your action, with your derivative, with your handling, and you get prepared to react for that. You don't expect that the future confirms your action. You are prepared to learn what happens and to learn from surprises how you will decide and how you will handle in the future. I suspect, for example, that's with the case of options, a very, very simple example. But even hearing what we heard now, for example, what Constance said in the discussion, that tools like high-frequency trading actually do basically the same. Because, or it has been said, they are sort of traps on financial markets. So in a sense, they are used to produce themselves information that will be used in deciding the future steps. So that's a sort of circular way of using tools in order to calculate something and to learn from the subsequent behavior of the markets which information you get from that. And that's also, after the crisis, what we can observe about the measures to react to manage the crisis, political measures, for example. They proved to be more or less effective, depending also, that's my interpretation, and on how they dealt with the future, with the bindings of the future. Because the issue, also political issues, is not to neutralize risk, but to learn to competently deal with, not only with risk, but with the riskiness of risk, with the unavoidable openness of risk. So the future is bound anyway. You cannot avoid it. If you don't do nothing, you, in a sense, prepare the future. But what we can do would be try to bind the future, in a sense, as open as possible, without claiming to control or to predict it. We just do something and then look what happens. And the people who deal carefully with the risk of risk do things without expecting to know how the future will be, but in order, in a sense, to learn from what happened, to learn from surprises. That, again, is not a completely new idea. Organization theory has similar construction since long. If you read Carl Weick, you know that's sort of a construction, the sense-making organization has this idea on its background. First you do something, and only later, looking back, you understand what its really meaning was. So you do something, understand, looking back, what you really have done. But that happens every way in our life, actually. Financial markets are interesting because in their much more formalized way, they're much more formalized than other fields of our social life. So they have more refined tools to implement this logic, much more than other parts of society. If they learn to use this instrument, this model, in a more complex way. The problem is, well, this very complex model are not used in a way that is theoretically complex enough. Because actually, what the models deal with are precisely time and risk, which are, I repeat it once more, the real issue of economy and economics as well. Thank you.
Thank you very much, Elena, for your brilliant analysis. Are there any questions from the... Okay, some remarks. I start here with Jan.
Thank you. That's really so interesting. For the sake of the discussion, I will try to object one of fundamental assumptions you made. namely that something went wrong and something didn't really work. Now, if you saw this documentary, $1 Trillion Bet, that tells the story of long-term capital management back in the 90s, guys who thought they invented this kind of Midas formula that they could predict correctly the price of stocks in the future, so they could make great bets and earn a lot of money. And for some time it really worked very, very well. They made a lot of money. They made so much money that they started using the stocks that they had as a collateral for credits to buy more stocks and so on and so on. And something completely unpredictable happened. Boris Yeltsin announced he would not pay, Russia would not pay part of its debt, right? And this really collapsed the whole model. That was actually the first time when Federal Reserves really intervened on a large scale. It was not very publicized, but it's estimated that they would lose $1 trillion if they were allowed to just go bankrupt. So I think that was a situation where something really didn't work and there was a risk of a fundamental failure. If you look at the last so-called crisis, so for the sake of the discussion, I would say it's difficult to prove that something didn't work, because what happened? Rich people got richer. 2009 was the best year for new billionaires around the world, everywhere, in the US, India, really. Some financial institutions went bankrupt, but that was not really a problem. People who were running them, like the guy who was CEO of Lehman Brothers, he got something like $100 million or something like this. So some people lost their jobs. Okay, but this only means cheaper labor. For capital, no problem. This is even good. This gives a chance to start some manufacturing in the US. And if it ever rebounces, this is because of the destruction of the crisis. And what I think was achieved regarding risk, I think it's a very, very important aspect, is that capital needs to externalize costs in order to further accumulation, right? So they don't pay for damage of environment, health, and so on and so on. Now with this subprime and this collateral, securitization of debt that they did, of mortgage, they actually managed to externalize the risk. Because for the risk that they would have to take, we all paid, right? Because they went to governments and they said, we are too big to fail, now you have to pay. Okay. So actually, it all worked very well. It's really difficult to prove that something didn't work for the financial market, not for the society, because for society, for capitalism is a basic failure. Yeah. But for them, it worked very, very well.
Yeah. Well, I perfectly agree with you and disagree at the same time. Well, I agree with your analysis. Of course, for the financial, or we can say that for the financial markets, it was not really a big problem. But, well, damage or not damage, you have to also specify who you are referring to. So from the point of view of the financial system, you could say that it was not a big mistake, but of course many people lost their money. But when I say they didn't work, I said in a more simple way, that a model showed that they were, in a sense, they didn't keep their promise. Because the promise of the model was you, ordinary people, you can invest your money and you are not risking anything. That should be what the model promised to everyone. And this promise was not kept, actually. That's in this sense, when I say something did not go, well, because you say something went wrong or not, you have also specified for whom it went it didn't work. So that's a sort of an indefinite question. You cannot say it's bad or good in a general way. But when I say the model didn't work, they said they didn't keep their promise. But still, the question is sort of tricky, because they didn't keep their promise. The people who were so confident they wouldn't lose their money, lost their money, or didn't have the gains that they were expecting. But the models, the tricky things is that you could never show where the models were wrong, but the models were right in a sense. And actually, as you were referring to, in the time before the crisis, for quite a long time, they really produced richness for everyone. People who could buy houses they couldn't have bought before, because the idea that you can use the future in the present is a very powerful and wonderful idea. When I want to refer to my experience, I got a credit, I could buy a house I could have bought before, and actually, since now there are no big problems, I'm paying my installments regularly, and I live in the house I couldn't have afforded at the time. So it was a good mechanism. And this mechanism extended this possibility to use the future and the present to everyone, had an enormous, well, forward-bringing and enthusiastic effect. So it's not really in a general sense, wrong. What was really wrong, they didn't know what they're doing, actually. Because as you show, it's enough that something goes wrong. They were sort of bound the future, and the future cannot be bound. In the future, always happens something that you don't expect. That's the meaning, that's the beauty of the future. And when this thing happens, you cannot really control anything anymore. And the point was not Yeltsin taking a decision. The point was not that the house of prices really fell, because that's a little event that under different conditions wouldn't have had these terrible consequences. The problem is that these events tend to produce a sort of chain of expectation, a sort of resonance, as they say, that was really the reason of the crisis. A sort of, as Christina said, a sort of break in the trust of the people about, because the models rely on trust, of course. And if this trust is not there anymore, then the whole construction sort of breaks down.
I think there is another question here.
I mean, you have a follow-up question on that, so I will keep mine later.
Yes, I think more fundamentally, these central banks and financial markets deal with a kind of model of the economy, which is converting to a kind of equilibrium. These are these dynamic stochastic equilibrium models. And if this kind of unpredictable future, which you explained, if that holds in this long-term view also, then you would state that these models on which our economy is governed on the central bank level are totally wrong. Is that really your opinion?
Well, I would say they are totally wrong, but I think I'm not the only one saying that. I have the impression in my listening that almost everyone said this. The idea that, well, sort of extended invisible hand, that the markets are able to regulate themselves, that can be, that equilibrium in the market is possible and is also something we should want. That's, well, I cannot help find this completely unrealistic and also useless. We don't need that, actually. Markets are much more complex, stimulated, interesting in this idea of an equilibrium, stable. That's, well, there are people saying, I think it was Losby saying that if this model were true, were realistic, we shouldn't have any markets anymore, because the market should reach an equilibrium once and don't move anymore. So they're actually unrealistic models. What's going on in the markets is more complex than that. But that doesn't mean, of course, that the old tradition of economics should be thrown away. And you can correct a couple of things and still use these models. But how can you expect that, well, I don't know. There's something similar about public opinion from a sociological point of view, that something can regulate itself miraculously like a sort of invisible hand. Well, I don't know what to think about it. For me, it's completely unrealistic.
I mean, I would follow up on also on his question. I think there is a tendency and a place in the hand of the bankers to have that mythology. There's a big irrationality in the markets. We didn't know what was to come, and there is the black swans, and we all didn't know, and we were surprised. But actually, if one looks at the outcome, as he said, the outcome was quite nice, and that poses the questions to what degree the bankers actually were completely able to calculate what crisis was coming, to use the crisis, never miss a crisis, no? To use the crisis in the best ways, and that is still going on. And we can see it by the central bank's attempt to taper, as they call it, to step out of the continuous funding of financial markets and asset prices. They instead create a situation where, so to say, not only we as a public pay the debt, but we continue to pay it for an indefinite future.
Yeah, well, I could agree with this description, but, well, would you agree if I tell the story a different way? Well, there were really banks which closed. So in a sense, the system was really destabilized by that, but it learned quite quickly, much quicker than we as theorists know to adjust our description of what's going on how to deal with that. Because actually markets, you know, on derivative markets or financial markets, really they are so abstract, so independent from production. That's something we should, or from the real richness of people. So we should really take them as a starting point. So for financial markets, if people are well off or not is completely different, because you can earn money by the crisis and you can lose money when finance went on, when it goes well. And financial markets actually do that, but we shouldn't be angry with financial markets because of that, because that's how they are done. But we should try to understand how it goes on, how it gets possible, and possibly to regulate it. I think a task to sort of control these things is not a task of financial markets, it's a task of the politics. It's a task of us creating constraints in order that this necessitates natural development of financial markets. Well, the idea, you can't accuse financial markets or financial operators of being greedy. That's the point of working on that. You have to be greedy. And then maybe you give some money like Warren Buffett and Soros for poor people and so on. But the action on financial market is based on that. And financial markets learn to exploit opportunities always and very, very quickly. But we should have a clear understanding of that. And the official description of what's going on, and I see that you also disagree with that, is not realistic somehow, that the crisis. Yeah.
Okay, I think we have time for one more question. Is there any question or comment or remark, any statement? Okay, then Jan wanted to.
Just very briefly, I don't think it's only a question of greed, it's a question of cynicism. They were cynical in the sense that Sloterdijk is talking about. They knew what they were doing and they were doing it, right? So, and that's the basic problem. So this promise was a sort of false promise. It had a structural role in maintaining consumption, because if you actually cut wages down, you don't pay people, so how are they supposed to buy the stuff you produce, right? It's the, Michał Kalecki, this Polish economist, he had this sentence that workers spend what they earn and capitalists earn what they spend, right? So if you don't pay people, they have to take credit in order to buy your stuff. So this promise was also a sort of egoistic, right? It served them, and also again the failure of several financial institutions is not a problem for the system. What many investment banks did with the state help, they bought another banks, right? So there were mergers, acquisitions, takeovers, and more monopoly. So it actually even furthered these tendencies.
Yeah. So I agree with that, but well, I have to say I'm a sociologist. And we as sociologists and look at society, we tend to have a sort of detached attitude, which for many other people is not so sympathetic, well, it's not so nice, I know that. For example, about the question who is good and who is bad, is it good or bad to be cynical? Well, we know since Mandeville, good intentions have bad results and bad intentions have good results. And the sociology should look at that. And the point is not who is good, who is bad, but how can you rule the system altogether, or can you sort of have compensations and reciprocal constraints between different areas of society in order to avoid, well, we would say, generally negative outcomes with as a crisis, because, well, of course, for the financial markets, the crisis was not such a catastrophe. But for our society, I think we would agree it was not such a nice thing somehow.
If you talk about the system and who rules the system, that poses the question of sovereignty. Who is the sovereign? And what the crisis was used for was to transfer the sovereignty from the states to the banks. So the banks run their system themselves. That's where we are.
Yeah. But that's a really open, difficult question, because also what happened to the crisis, there's people who say the market governed politics, because politics, well, in Italy, you only talk about economics, so the politics is running after the economy. Or you could say on the other side, the markets show that they need politics, but they are not able to rule themselves by themselves. So I think this question of sovereignty is not this question of a top of society or a place in society that rules everything. It's just a question of reciprocal constraints between different areas of society. So the economy sort of influences politics reacts to try to influence economy, and it should be done in a possible more circular and reflexive way. It's a question of complexity, not a question of who is the ruler.
I think we still have a lot to discuss. I think we should go on maybe a little bit later, because we have the next panel running at 6 o'clock. So thank you very much for your inspiring talk, Elena Esposito. Thanks.